President Trump renews his threats of steep tariffs, but do markets believe him? President Trump again extended his deadline to secure country-by-country trade agreements, this time until August 1st. The announcement came posed as a threat, with letters warning of tariffs ranging from 25 to 40% next month. But there was little panic among traders. S&P 500, already in a declining pattern when the announcement hit, fell another fifth of a percent. Chris Beauchamp is chief market analyst at IG. So Chris, why is this? Are traders simply ignoring Trump's threats?
Yes, I think so. The same sensible answer would be markets are pricing in a reasonable outcome here because of what we've seen. I think that my gut feeling is more that just nobody believes them anymore at this point. The administration saw the chaos it had in April, and I think they just don't want to repeat of that. So they can talk a good game, and it doesn't hurt him to have these tariff threats hanging over key trading partners, and it makes him talk a tough game. But this just doesn't feel like their heart's in it this time around.
Well, let's look at June inflation, a print due up next week, and signs of tariffs driving prices higher have been minimum. Are fears overblown?
Well, this is the other thing, of course, because we're still waiting for this tariff bump to come through. Has it been absorbed, or has it been pushed down the line because of restocking? So that will the impact be muted? Maybe because companies are absorbing this tariff increase and prepared to sort of take the hit and then move on, or maybe increasing it only gradually so that everyone can get away without noticing it too much. I think we need to be careful here because if you look back to his first term, it was usually about 4 to 5 months before we really started to see impact of tariffs coming through. So it might not be there yet, and this could put the rally under pressure as we come into the usual August and September period rather than getting it next week. But definitely the CPI readings remain the thing to watch.
So how will the Fed be reading the tariff delay? Could the central bank be on wait-and-see mode for longer?
If I was the Fed, part of me would be fervently hoping for some inflation so they could at least say to the White House, see, we told you this was what we were waiting for. This is why we haven't cut rates. Because, of course, while I think the Fed will be overall happy if inflation doesn't respond significantly to these tariffs, it does mean that they'll be in for another round of, if you like, punishment beatings from the White House, certainly for poor old Jerome Powell, who will be in the firing line again for not cutting rates. He's set to endure months of this, I expect, unless and until inflation starts to respond. But I think they'll be relieved that inflation doesn't respond if that's the case next week. And it does at least give them wiggle room when it comes to September and potential rate cut, because we saw with the payrolls last week, the private payrolls figure continues to weaken, and that is strengthening the case for a move in September.
Goldman Sachs just lifted its S&P 500 return forecast this morning. They say a gain of 11% over the next 12 months. Do you see this as likely?
Well, I think it's certainly much more likely than it was just, say, 90 days ago, oddly enough. The optimism has returned to an extent, and I think the way US equities have performed since those April lows will inevitably mean you just see a lot of inflows getting back into the market and helping to support it. Now, going back to what we were saying about inflation and the impact on earnings, if we can see only a moderate impact, then I think markets will continue to view US equities relatively favorably. So, yes, I think it's no surprise to see targets for this year and next being revised higher, and that should continue to be the case, really. It doesn't rule out potential for some volatility in August and September, as is often the case. But US equities are in a much better position now, and earnings overall look to be a lot more of a safer bet, really, than they were just about 2 months ago.
Chris, let's finish on the dollar, and some have argued that the extent of its drop this year is modest. A weaker dollar is Trump's aim. Does it have further to fall?
Well, I think you've got to be careful at this point. It depends, of course, as ever with a lot of this work, depends where your entry point was. Because if you were short the dollar from months ago, you're still very happy and you tend to sit on it. Positioning, of course, is very underweight the dollar. And if you do get a bit of an uplift in inflation, if that causes the Fed maybe to sound a touch more hawkish, you could see quite a dramatic repricing in the short term. Nonetheless, the way to go over the last few months has been to sell the rallies in the dollar, and that still seems to be the case. And of course, this weaker dollar gives Trump a bit more leeway with his tariffs as well, because it helps make earnings coming into the US improve the earnings situation for companies from overseas. So I think it is likely that you see further dollar weakness as we see further expectation of rate cuts going into September and possibly even beyond that.
Chris Beauchamp, Chief Market Analyst at IG. Don't forget, you can watch more videos on Reuters.com.